Welcome back. Happy New Year. How the heck are ya? Did you get some rest? Did you get stuck somewhere? Did your flight get canceled? Did you have to drive across the country to get back here? So many crazy things went on just in the last couple weeks. Anyways, I'm back. It's 2023. Another episode of The Brief. It's January 4th, 2023. And I still don't see flying cars outside. We were promised in 2000, and 23 years later, there's still no flying cars. Anyway, guys, welcome back. Let's jump right into it. Hope you guys had a great holiday. Happy New Year. A lot of stuff went on during the holidays, just crazy weather, people getting sick, stuck, all this crazy stuff. I know people are still getting back into the office, getting to the swing of things, writing down your goals. I want to do this. I wanted to do that. One thing I talked about today, let's just talk about goals real quick, because obviously, why not, right? And for you that don't know me on this video, maybe you don't follow me on social media, maybe you don't know this about me, I'm a guy that wakes up between 3 and 4 o'clock. I've done it consistently for many, many years now. So it's just a habit. I love it. It's me time. But what I will tell you, if you're trying to lose weight, trying to start a business, maybe trying to hit the gym, get up early to do more stuff, you time, one of the things you got to tie that goal to is a why. So when you have the why you're getting up, let's say, hey, I want to live longer. I want to be healthier. I want to be around for my kids, my grandkids. When you tie the goal to a why, the why out trumps the goal. It's very easy to get up out of bed and go hit it. Don't get me wrong. Let's be honest here. Does every single day, 365, 24/7, do I get up at 3 to 4? No. Is there a 5% of the time I get up after that? Yes. But sleeping in for me is much late, is 5:30, let's say, for example. But anyways, let's get back to it. So let's talk about real quick, inventory. Obviously, as you guys know, last week was dead. I was out of town. I wasn't really doing much like a lot of people. So inventory, new listings is way down, sales, pending sales, all that stuff. So crappy week for real estate. Still transactions happen, but it was slow. So let's see what happens as we pick up here into the new year. But one of the things I really want to talk about today, before we jump into the other stuff, is Freddie Mac just came out with a big announcement. I think this is going to be one of many, so pay attention, because there's going to be a lot more changes that could catch you off guard. If you're a real estate investor, if you're looking to cash out and things like this, things are going to probably get tighter if we get into a recession. And what you do is watch what Fannie and Freddie and people and those institutions do, because remember, they fund 97% of the loans. 97%. So Freddie Mac just came out and they said after March 7th, so for us, if a loan is purchased after March 7th, they are now requiring for cash out refinances, are you ready? 12 months seasoning. Yes, we are going, so what's happening is they're going to start pulling back. They're going to start getting more conservative. You might start seeing, we want seasoning for a new value. You might start seeing, we want more down payment. You might start seeing things change throughout the year. Don't be shocked. Don't be alert. I know it sucks. I know it's frustrating, but keep in mind, there are other options. There's HELOCs. There's probably other programs come out, portfolio programs, something like that to, help with the gap, fill the gap in. But this is what happens. So you have to listen and pay attention to what are the biggest buyers of mortgages doing. What did they already do? They're helping a first-time home buyer by decreasing the hit levels, like pricing levels, right? So it's cheaper to get that loan from a cost level and rate level. They're going to start hammering you on cash out refinances, right? They're hitting you when you buy a second home. You know what I'm saying? They might scrutinize for investment properties. They want more seasoning for new value. So it's not out, but we got to use our brains. We got to go backwards. For you that might have been in real estate the last 3-4 years, yep, it's been great. Low rates, easy breezy, selling homes left and right. Maybe you're a real estate investor. It's been easy, but challenging times create more conservative lending, and that's what's going to happen here. The other thing I want to talk about this week is what is going on in the macro environment, right? So we're going to be looking at job cuts right off the bat. Like today, as I shoot this, Salesforce announced 10%, right? Boom. We're going to start seeing Facebook and Salesforce and every tech company go down the list. I guarantee you is going to start slashing jobs. Let's talk about that for a minute because it's going to go into everything else. It's about inflation. It's the job cut. It's the Airbnb market that's having problems. It's everything. It's the inflation. What happened is we were locked up. Then they opened the world up, and everybody's like, I want to go on vacation, and I'm going to go to everywhere in the world. And everybody's like, cool, I'm going to buy a VRBO, and I'm going to have this cash cow machine. It was great. Then all of a sudden, everybody's like, well, I went on my 2-3 trips, and it's back to reality. I went through my savings, and those people that bought all these vacation rentals all over, they're like, oh my gosh, I was filled 80%. Now I have zero people coming. What's going on? Guys, it's the same things. The tech companies, people, they, out of the pandemic, they overhired. Look at Amazon. They're getting all this business, Facebook, all them. They overhired. The CEOs went way overboard, and now they're pulling back. How much are they going to pull back? We don't know. This is the first start of many cuts coming. So you're going to see job cuts. Then you're going to see inflation hopefully start coming down. Interest rates are kind of remaining stable. They're a little bit higher than they were a couple weeks ago. It's really hard. There's just going to be a lot of moving parts, a lot of stuff going on in the economy. So you guys are aware over the next just 2 to 3 weeks. The next 90 days is probably going to be very volatile. It's really hard to say what rates are going to do. It's really going to come down to what's happening with jobs, what's happening with the consumer, what's happening with inflation, and what's going to happen with rates. And then we got our big bad boy, Jerome Powell, that's in charge of the Fed. Yes, he's probably going to continue to slowly raise rates. Remember, we already talked about the 5 pivots. One pivot was language. The second pivot, he went from 75 to 50. I think he'll go 50 to 25. Then he'll go flat. And then he'll probably start decreasing. My guess is toward the end of the year. So right now, we're looking to see if he's willing to go from 50 to 25 to start easing off the gas, basically the brakes, since he's jacked rates up higher than ever in that short period of time. And so when you combine all this stuff together, what do you got? You got a bunch of confusion. You got a bunch of scared people, consumers, buyers, sellers, real estate investors, stockbrokers, everybody's like, I'm shopping at a store. The guy's like, everybody's talking about the recession, the R word, right? And that's the next thing. So are we going to have a recession? Is it going to be a hard landing? Is it going to be a soft landing? Is it going to be long? Is it going to be short? Nobody knows this stuff. So we can get on here and talk about it. We can look at it. We can look at the data. All we can do is literally take day by day, week by week, month by month, and see what's going on here. But what I can tell you is that there are opportunities in real estate right now. People are getting deals. They're getting lower than the listing price is already lower. They're getting closing costs paid for. They're getting solar paid for. They're getting, the roof repaired, this repaired, the selling. The buyers are in the game. They are winning it. And the sellers are basically having to pay to play. I've said this many, many times. So the opportunity is here. I think there's going to be a lot of opportunities in real estate. There's going to be a lot of opportunities in the stock market, like a lot of things coming here. A lot of things coming up with bad news equals opportunity. So for some people, they're going to feel the pain. It sucks. Other people are going to be able to execute on this opportunity. And then just to wrap up this week is 2023. We're here. The holidays are over. It's amongst us. What do we expect? Look, there's no point to look further out. I think, like I said, we're going to expect a lot of volatility, a lot of job cuts. If they have to cut more, they're going to cut more. We're going to expect the Fed to start seeing if he's going to back off to 50 to 25. Let's see what happens there. Inflation hopefully comes down. We've got the House, this House is now, the Republicans are going to be a majority there. So a lot of gridlock in politics and Wall Street and all that garbage, right? And then we have an election year coming in 2024. So as we get into the end of this year, see who's going to be running for president, all this. So it's going to be a crazy, wild ride this year. There's going to be a lot of opportunities. We'll be here week after week, day after day, month after month, deliver you the news, the data we got. But look, stay positive. Lots of opportunity out there. I know this video is a little bit longer than normal, but I wanted to wish you guys a happy new year. Hopefully you had some good time to take off, friends, family. Hopefully you're healthy. And, look, focus on what you can do. Don't focus on all the bad stuff. But we're here if you need us. Have a great week. We'll see you next week. Let's see what it brings. See if rates go up, down. It'll be interesting to see, right, guys? Catch you next week. Thanks.